Most people imagine that getting rich in the stock market requires picking the next big winner, timing the market perfectly, or having insider access to information the rest of us don't. In reality, one of the most reliable paths to real wealth has been quiet, boring, and available to almost anyone: the index fund. Millions of ordinary investors have built substantial nest eggs simply by owning a small slice of the entire market and leaving it alone for decades. This isn't luck. It's the predictable result of a few powerful financial principles working together. What an index fund actually is. An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to track a specific market index, such as the S&P 500, rather than trying to beat it. Instead of paying a professional manager to handpick stocks, an index fund simply buys all, or a representative sample, of the securities in that index, in roughly the same proportion. If you buy an S&P 500 index fund, you effectively own a tiny piece of 500 of the largest companies in the United States, everything from technology giants to consumer goods makers to banks, in a single purchase. This sounds almost too simple to be a wealth-building strategy. But that simplicity is precisely the point. 1. Broad diversification reduces catastrophic risk. One of the biggest ways people destroy wealth in the market is by concentrating too much money in too few stocks. A single company can go bankrupt, get caught in a scandal, or simply lose its competitive edge. When that happens to a stock you're heavily invested in, the damage to your portfolio can be severe and permanent. Index funds sidestep this problem by design. Because you own hundreds or even thousands of companies at once, the failure of any single business barely dents your overall return. Meanwhile, if even a handful of companies in the index perform spectacularly, your portfolio captures that upside too. You don't need to correctly guess which company will be the next great success story. You simply own all of them, so you're guaranteed to hold the winners along with the losers. This diversification doesn't just reduce risk on paper. It reduces the emotional risk of investing. The temptation to panic sell after a single company's stock craters is much lower when that company is just one small piece of a much larger, more stable portfolio. 2. Low-cost compounding to large sums. Index funds are famous for their rock-bottom fees. Because there's no team of analysts trying to beat the market, no expensive research department, and no frequent buying and selling, index funds can be run for a tiny fraction of the cost of actively managed funds. Some S&P 500 index funds charge an expense ratio of well under 0.1% per year, compared to actively managed funds that often charge 1% or more. That difference might sound trivial, but over decades it is enormous. Fees are subtracted from your returns every single year, and thanks to compounding, a small annual fee doesn't just cost you that fee amount, it costs you all the growth that money would have generated over the following years. A 1% annual fee can consume a startling percentage of an investor's total returns over a 30 or 40-year career. Index funds let investors keep nearly all of the market's return for themselves rather than handing a meaningful chunk of it to a fund manager, year after year, for a service that often doesn't even outperform the index it's trying to beat. 3. Most active managers don't beat the market anyway. This point matters because it removes the temptation to think that paying more for active management is worth it. Study after study, including regular reports comparing actively managed funds against their benchmark indexes, has shown that a large majority of active fund managers fail to beat their index over long time periods. Often 80% or more fail over a 10 or 15-year stretch. The reasons are straightforward. The market is highly competitive, costs eat into returns, and consistently outguessing millions of other investors is extraordinarily difficult even for professionals. If most professional stock pickers, with all their resources and expertise, can't reliably beat a simple index over the long run, it becomes clear why an ordinary investor is usually better off not trying to either. Index investing is essentially a decision to accept the market's average return, which, historically, has actually been quite good, rather than gamble on being one of the rare few who beats it. 4. Long-term compounding does the heavy lifting. Wealth from index funds isn't built through dramatic short-term gains. It's built through patient, long-term compounding. Historically, broad stock market indexes like the S&P 500 have returned an average of roughly 7 to 10% per year before inflation over long periods, including dividends. That may not sound thrilling year to year, but compounded over 20, 30, or 40 years, that steady growth transforms modest, regular contributions into significant sums. Consider the simple math. Money invested early has decades to double and redouble. A relatively small amount invested in your 20s can grow far larger by retirement than a much bigger sum invested in your 40s, purely because of the extra time compounding has to work. This is why financial advisors so often stress starting early, even with small amounts, rather than waiting until you have enough money to invest seriously. 5. Simplicity encourages consistency. Perhaps the most underrated reason index funds build wealth is behavioral, not mathematical. Because index investing requires so little ongoing decision-making, it's much easier for ordinary people to stick with it. There's no need to constantly research companies, follow the news for stock tips, or agonize over when to buy and sell. This simplicity dramatically lowers the odds that an investor will make the classic wealth-destroying mistakes: panic selling during a downturn, chasing hot stocks after they've already risen, or trying to time market tops and bottoms. Many index fund investors use automatic strategies like dollar-cost averaging, where a fixed amount is invested on a regular schedule, say, from every paycheck, regardless of what the market is doing. This removes emotion from the process entirely. When the market falls, the same dollar amount buys more shares. When it rises, it buys fewer. Over time, this disciplined, automatic approach tends to work in the investor's favor, and because it requires so little effort, people are far more likely to actually follow through with it for the decades needed to see real results. 6. Accessibility levels the playing field. Index funds have also democratized investing in a way that was uncommon a few generations ago. You don't need a large sum of money, a personal broker, or specialized financial knowledge to start. Many index funds and ETFs can be purchased with very small amounts through ordinary brokerage accounts, and retirement accounts like 401(k)s and IRAs frequently offer index fund options as a default choice. This accessibility means the wealth-building power once reserved for those who could afford professional money managers is now available to nearly anyone with a bit of money to set aside and the patience to leave it invested. The real secret: time in the market, not timing the market. If there's a single theme tying all of this together, it's that index funds make people rich not through any clever trick, but by removing the obstacles that typically prevent ordinary people from capturing the market's long-term growth. Sidesteps the near-impossible task of picking winning stocks. And the simplicity of the approach makes it far easier for real people to stay invested through decades of ups and downs, which is where the real compounding magic happens. None of this means index investing is risk-free or that markets always go up. There will be downturns, sometimes severe ones. But history shows that investors who consistently contribute to diversified index funds over long periods, and who resist the urge to sell during scary headlines, have been rewarded far more often than those chasing quick wins elsewhere. Getting rich this way isn't fast or flashy. It rewards patience, consistency, and a willingness to let time and the broader economy do the work, which, for millions of everyday investors, has proven to be one of the most dependable paths to financial security available. This article is for general informational purposes and does not constitute personalized financial advice. Consider consulting a licensed